I'm Monica Young. I'm the broker of Just Global Inc. and also the host of Global Real Estate Investor Forum. Today, we have invited Mr. Philip Guan, a CPA that I come to get acquainted with some radio show. And I'm going to share with you a bit more about the market update and also some information about the trend for next year. So I hope you will find this information useful for your strategy and plan for next year. Next slide. So you might have heard a lot of bidding wars have been going on, not just, in South Bay, but throughout various parts of the Bay Area. So in terms of like California, the median home price actually has been forecasted to be $648,000 and is actually going to be even higher. And at the same time, the sales has been going very strong. So in spite of the pandemic, that we have a little low tide, in March to May area, this year has been going very, very strong. So we're forecasting 392,000 single family homes resale, for this year, next year. Next slide. So basically, as you can see on the news, you have heard a lot about jobs being lost because pandemic. And like in California alone, it's 2.7 million jobs lost. And we are able to recap about 1.7 million. There's still a gap of about 1 million. And if we're talking about the trend, another 400,000 to be catching up. There's a lot of jobs that we're not able to fill, not easy to hire people. And we hope that gradually we are going to get there. But so far, the housing market has never stopped and even get actually red hot, in spite of the economy. Thanks. Next slide. So high wage sector, if we are talking about job loss, you can see that hospitality, leisure is one of the sector that is most hard hit. And there were 985,000 job loss, and they were able only to refill about 600,000 jobs. And whereas in others, retail, of course, has also been impacted because restaurants and a lot of department store, they kind of like having the pandemic issues impact. Not many people are going in person, but rather go online to shop or get delivery. So the only sector that you see pretty dramatic increase is the logistics sector. Thanks to everyone who are buying all your merchandise online and also ordering food online. So, more jobs been added. So you can see that it's the only green that you see surpass after the pandemic. Next slide. So rates going back, the rates have been actually doing pretty low all the time. And we have historic low rate. And because of that is actually having an impact on the market. And right now, as you might have heard, 10-year bonds still like rumbling 1.5, 1.6. And then if you're doing a 10-year fix or 30-year fixed rate, for conforming, you could get as low as like 2.625 or hovering about 2.75%. And adjustable rate, I still have clients who can lock in adjustable rate 7-year fixed for 2.15%. So all this filling housing growth, you can see that year to year, we have 28% growth in terms of sales. And then in terms of price, the median home price in California has gone up 16.8% to $717,000. Inventory become very, very tight. We only have 1.3 months of inventory, which is 48% drop year to year. So because of the lack of inventory and also the increase of buyer being that the interest rate is very low and many people want to get into a house, and also the stock market has made many people more affluent. So that's why more people are looking at buying homes. Another factor you might have heard is inflation. The inflation rate recorded is 6.2% in October. So many of my clients, they want to buy homes because of the protection of inflation. They can get brick and mortar to avoid inflation. Next. So you might be interested to know what type of cities actually have the strongest growth. As you might have guessed, a lot of people will be able to work remotely. They can work from home, or definitely not needing to go into the office. So some of the areas that you might have not have guessed, like Big Bear has gone up 100% in sales. Tahoe City or South Tahoe has gone up like 50%. Many of the more like resort or scenic area that they actually been benefiting from the pandemic factors. Next. First-time home buyers, as you might have heard, now of course, homes become more and more expensive. The people who are buying the homes to be owner-occupied become a bigger percentage. So first-time home buyer has been near decade high. So we have about 35.5% of the people buying homes today, first-time home buyer. The long-run average is about 37.2%. And we also have some trade-up buyers. So personally, I've been working with a number of first-time home buyers. I was able to get them homes, as well as some of the trade-up buyers. They've been doing very well in buying and also selling. And also we do have some program that can do bridge loan. So in case you're thinking about either trading up, say selling your townhome, moving in a single home, or if you want to trade down, you want to sell your own primary because of Proposition 19 and get your property tax base protected and move into a smaller home, a one-story home, will be able to help you with a specific program that allow the financing to be bridged. Next. Well, sales, in fact, are growing fastest in California core. We're talking about Bay Area, 32.8% overall. And Southern California or Central Coast also doing quite well. But overall, California, we've seen that 21.3% growth in sales. Next. Well, we're coming into a slide to talk about the forecast. So for next year, they're still expecting a pretty robust growth. The GDP is expected to grow by about 4.1%. And the job growth is about 3.1%, whereas in employment, we have pretty bad impact because of the pandemic. Last year was 8.1%. This year is doing a bit better. So it is 5.6% projected, and then 4.3% to be forecasted for growth. And CPI, as you might have heard, like everything becomes so expensive. And they forecast to be 3.2%, but I think they've taken away maybe energy and food. So far, we all get pinned when you see the gasoline is $5 per gallon. So we're expecting the CPI to continue to be kind of like a high index. Next. California, I think we've been doing quite well in terms of job growth and employment, even though we still have a high unemployment rate of 5.8%. And also in terms of population growth, you might have heard a lot of people left California. 260,000 people actually left California last year. But thanks to being that the tech sector is still hiring, I still have like clients who are coming from out of state, and plus the natural growth and immigrants. So I think we're probably holding pretty steady at 39.5. And because the housing is such a crunch that we don't have enough supply. And I think the high price arena will continue to be happening in the Bay Area and throughout the rest of California next year. Next one. Housing market. So this is something that you probably all be concerned. Hey, are we going to see some kind of like stabilizing? The association forecast is, so like this year, the projected growth is about sales for housing, like this year, like so far we have 6.8%. Next year, they think the sales might drop a bit because of the supply is still very limited. However, you can see that the median home price will continue to go up because supply is not enough to meet the demand. So with the inventory drop, they expect the price to continue to go up throughout the California. It's really high, 834 as median home price. And then they're expecting about 5.2% increase in home price next year. And affordability index will drop from 26% to 23%. So only 23% of people will be able to afford to buy homes. So it's even more challenging. But the rate they forecasted to go up next year. Next. Okay, we do have an open house this weekend. And so it would be 2 to 4:30. And this is a very good size home, about like 2,400 square feet, 5-bedroom, 3 baths with a bedroom downstairs in the South San Jose area close to Blossom Hill. So if you're interested to check on housing, or you have any of your relatives or friends looking for homes, do come by. This is a very nice home, fully remodeled and move-in ready. And this is in the Blossom Hill area, 95123. Next. So we as a team, we do a lot of local real estate business. It has been a very good year for us. We are definitely ranked among the top 3% of the whole county. And also we're helping a lot of investors to look out of state. So we encourage people to start early, especially if you're thinking about maybe your second generation. Homes in out of state would be more affordable. It could be anywhere like mid 300 to all the way maybe 400 something. The interest rate also very high, very, very affordable now. So it would be a good timing to talk about it. So feel free to reach out to me or Carl if you do have any question or interest. Yeah, Carl, can you please let our speaker to log in? So before my speaker will load up their presentation, I'd like to introduce Mr. Philip Kwang. And prior to Philip setting up of his own practice as CPA back in 2002, Mr. Kwang completed his education in San Francisco State U, and he also received his Master of Taxation from Golden State University. And before he has his company, he worked in the tax department of Arthur Andersen and accumulated very wide spectrum of experience in tax reporting. And he also conducts a radio show at 2 p.m. every Saturday in Cantonese on Chinese radio. And I'm a fan of him. Well, welcome, Philip. Yeah, now you have the forum. Thank you.
Thank you very much. So nice introduction. Okay, so let me get myself share screen so that way we are going to get the information started. Okay.
Yes.
Okay, let me see. Share my screen. Can you see my screen?
Yes, I do.
Very good. Again, welcome. So today we are going to talking about the 7 tax saving tips before the end of 2021. So which we have about 40 days. So you actually have my information. You also have my web pages. So now let's go into the film. This is my picture. Now this is one of my office. This is my twin daughters and my wife in the middle. Okay. There are 3 steps to take care of your tax matter in the right way. The 3 steps as follows. The step number 1, tax planning. Step number 2, tax in action. Step number 3 is the tax reviewing. So let me go to each and every step, talk about what is each and every step and how we should do it. Well, as far as tax planning is analysis and arrangement of a person with the financial in a situation in order to maximize your tax bracket and minimize the tax liability in a legal and efficient matters. What does really mean? Well, in the common word is everything under the law, and we do it things in the legal way that you maximize every available tax deduction, allowance, rebate, credit, so that you achieve legally pay the least tax liability. Now, when actually is the best time to do the tax planning? Well, the tax planning normally happen is before the beginning of each year, quarter, or month. You can do the tax planning for yearly, you can do the tax planning for quarterly, as well as monthly. For example, at this right moment, for the tax year of 2021, the best time to do is supposed to be in the last year of this time, in the 2020, in the fourth quarter. The first tax planning should happen like that. And then now we're in the tail of the tax planning for the year of 2021. We only have 40 days to go to do something so that for you to plan better. However, the cycle of those 3 steps are continuing. And sometimes in the same time, you are reviewing for the last period and you're planning, you are in action for implement what you plan to do, and you also planning and implementation. They are all like kind of like a cycle. It's a full cycle. So now, the next step is called tax in action. It normally happens during the tax year or during each tax period. During this period of time, you need to literally to implement what you have been planning. Now, in a tiny matters. And that's very important because a lot of the tax matters have tax deadlines. When you miss the deadline, some of them you cannot undo it. Tax reviewing is normally happen after each period. The tax reviewing could be done yearly, quarterly, or monthly. In these reviewing steps, you review how your tax planning strategy was implemented during the tax in action time. What strategy works for you, and you should continue. What strategy doesn't work very well, you probably need to replace it, especially the tax law is continually changes. And as well as your tax situation change. With those 2 major changes, your tax strategy should come along to doing modification. So now, what should we do right now? Now we are following the very end of this 2021, 40 days to go. This is the last opportunity to do tax planning for the year of 2020. Today, I'm focused on the tax planning tips for the year of 2021. And that's what we're going to talk. Okay. Let's get it in. The very first tip. The very first tips is you should maximize the contribution to retirement account timely. So what does it really mean? Well, to qualify a full annual IRA deduction in 2020, so the very first thing is you must not be participating in a company retirement like 401k, 403b, so on. If you are eligible, you must have an adjustment gross income, which is AGI, for a single person, 66K, for a married 5 joint person, 105K. If you are not eligible for a company, but a spouse is, your traditional IRA is fully deducted as long as your combined AGI doesn't exist 198K. So those are the new rules for the tax year of 2021. About after 40 days from now, when you come to your CPA, that's what the rule apply to you. But some of the information you need to understand, and you need to make sure to apply it. So what is the maximum IRA contribution for 2021? Well, for 2021, the maximum IRA contribution you can make it is normally $6,000. But if you are 50 years old or older, by the time of December 31st of 2021, like if your birthday is December 31st, so you just turned 50, you qualify. They count it the last day of the tax year. Now, well, for the self-employed person, the maximum annual additional to SEP or for the retirement account is actually 58K, which is good. Now, for the self-employed person, even you are qualified SEP, you could also qualify for IRA. So it's a combination. Now, well, if you receive a W-2, you also participate in a company 401k. You may not qualify to purchase tax-deductible IRA. So, because of that, your only option left you doing something right now before the end of the year to increase your 401k contribution if your company allows you to do so. And also have to be take it out and count it. So don't do it as a last paycheck. Sometimes the last paycheck you process and count it for 22nd. So do it early. Now, for 2021, the contribution limit for 401k is $19,500, the same as last year, haven't changed. Well, if you are 50 or older, you're taking advantage of catch up. Now, so you can put aside a total of 26,000, which is pretty cool. So in short, the 401k rule, 2020 and 2021 the same. Now, how can you figure out how much I have been put it in? Well, in your paycheck, there's a year-to-date number. And that year-to-date number under the 401k contribution, that is the amount for the year of 2021. So now let's get to the tips number 2. Is legally offset the capital gain or capital loss turning. Well, the stock market is pretty cool. And a lot of people making money in stock market. And a lot of people have been shown their gain as a recognized gain. As far as the tax law right now, you making gain inside the investment account if you have not been shown it. At this moment, the tax law still doesn't count it as a recognized gain, not taxable. They're talking about, but have not become a law yet. Even those unrecognized gain may become taxable in the future if they become law. Now let's focus on the current law as right now. They're not going to change in the next 40 days. So many people want to sell some stocks at loss to offset the recognized gain. However, if you choose a long selling time, the capital loss that you intend to offset the capital gain that you already showed it is not legally tax deductible. We call it watch sales. You say, what? A lot of people say, how that could be? Well, to protect my client privacy, I'm not going to say a lot more, but it's one thing I would like to tell you. in one time, in my client's account, there's a watch sale more than $1 million US. More than $1 million US. In that tax year, that client actually lose money on their book, in the investment book, for about more than 600,000-700,000. But because of this watch sales, he ends up taxable about 400,000. How that could be? Now, this is something I would like to talk about. What is a watch sale? A watch sale is an introduction, is a transaction in which the investor seeing the maximum tax benefit by selling something security at the end of calendar year, like now, so that you can offset each other. But here's the problem. They choose a long time in to sell something. So what that really mean? I want to show you. Here's a key point. As notes, you want to offset. The tax law allow you to legally offset if you follow all the tax law. However, here is something in the last point. If you sold something, now today is Saturday, the market is not open. Let's say yesterday. Yesterday was Friday, November 19th. If you want to show something at loss, let's say you show something at loss, 50,000 loss. You are thinking about to offset what you have in the book, the recognized gain, 55,000. However, let's say it's an ABC stock, and this ABC stock, you happen to buy this ABC stock 20 days ago. You buy something. You buy exactly the same thing, just one share. Because you purchased one share 20 days ago, within a 30-day period, your 50,000 capital loss is not legally tax deductible. It's called watch sales. And from yesterday, November 19th, go forward the next 30 days. So December 19th, or December 18th to be exact. If you happen in a December 15th, purchase just one share of the same stock you have been sold, you make the previous transaction, the 50,000 loss, not tax deductible. I copy this one from the internet. So this is a work from them, and I appreciate it. So now I want you to see how the watch sales rule happen. It's before 30 days, after 30 days. So you really have 61 days, not 60 days, 61 days. You say, come on, Philip, is it matter? Yes, it matters. If you can screw up in just exactly count 60 days, because those days you cannot change it. It's sold in those 1099 report from the investment company. And those reports also send it to IRS. Before they reach you and reach IRS, those investment company already count it as a watch sale for you. It's by law they're required to do so. So in summary, you need to legally to try to avoid that what self. So what you need to do, you need to keep a very good record of your purge history. And that's very important. That's very important. Are you still seeing my screen?
No. Just stop sharing the presentation. Only see yourself. Philip, you might need to log in again. Yeah. Well, I think the speaker might have logged out, so I need to request him to log in again. So in the meantime, we are trying to get Philip to log back in again. He does have a very thorough, comprehensive presentation of like 47 slides. And so we do hope that he would have enough time to finish.
Monica, can you
Yes.
share the slide after the seminar?
Yeah, I did. Actually, I put it on the chat box that we're going to share all the slides that are going to be featured by Philip today. And then we also recording the event. So, but like for some reason, I think he was locked out. So because of the internet, maybe his internet is not very stable. But definitely, we are going to record it and put it together. We're going to put it on YouTube.
Oh, that would be great.
Yeah.
Today's coverage, the Biden's a new tax law change to be passed.
Yeah, well, you know, like I think he might touch on it, but like say, I think because of the tax saving strategy he is going through, that he has quite a bit to cover. But like I have made a request on that. So I think he's trying to log in again. So he should be on again.
Can you hear me? Can you hear me?
Yeah, now we can hear you, Philip. Yes. So
Okay,
if you could
Okay, I think I need to go back a little bit so that way we get everybody in the same pages. But do you hear my what cells?
yeah, we heard your discussion about washout, but then
Okay.
we're not seeing your presentation slide right now. Mhm.
Okay, I'm trying to share my screen right now. Share my screen right now. Let's see. Technology is good, but sometimes it just happens. Okay.
Okay, now we can see it.
Now you can see it. Now,
Yes.
again, this is a very good job from the internet. I copied from it, as you can see in the left corner, okay, to make it very easy to see that when you show something at loss, before you hit the button sell, you really make sure you look in your purchase history. In the past 30 days, you have not been purchased a single shares of this stock. And also you need to mark the date in your calendar. In the next 30 days, you're not going to buy a single share of this same stock. So you have 61 days. And that's very important. So let's continue the presentation. The third tips is knowing what tax record to keep timely. Well, normally keeping the tax return and document is in case as after during some COVID, which means they audit you. Typically, IRS has a 3 years of time step limitation in a normal situation to audit your tax return. That doesn't mean only 3 years. So there are some special situation, they are more than 3 years, and those are the foreign information. For 6 years, if you underreport your income for more than 25%, 25% of what? Of your net income. Oh, 25% net income is sometimes is not, so it's looking for the total income portion of it. So you have a 6 years. If you write off a lost stock of become a worthless, you have 7 years. Funny, huh? So not 6 years, 7 years. You need to prove. Now, and the last is if IRS can prove you are committing a tax fraud, it's unlimited of time. So therefore, to save yourself, to defend you are not committing a tax fraud, you should keep your record as long as possible, especially when you connecting with real estate, especially real estate investment, development. You just keep the real record. Nowadays, there's a lot of record could be destroyed, right? You can destroy the original after like 6-7 years, the original record, but you can scan it and keep it in the electronic copy. So you can save them space, but you should have it. And you should also keep it not only in the local computer, but you also have a safety online storage as well. Okay, so then let's look at tips number 4, choosing the right legal entity for tax purpose, TANRI. The tax law allows taxpayers to choose the right tax entity. For example, a C corporation is subject to double taxation. What's double taxation mean? The corporation pay their corporation tax and then go to the individual shareholder, pay their individual tax for the same income. For example, like the same net 100,000. As we speak it, for IRS, C corporation is 21%. State of California is not exactly 9. It's 8.85. So let's say round it up 9. So you add together is about 30%. 30% for state of California. Now that for C corporation. So you make 100,000, you pay 21,000 to IRS federal. You make approximately 9,000 to state of California from the corporation, and then the shareholder get the dividend. They also need to pay the individual tax return. On the opposite, on the other hand, the S corporation is not subject to double taxation. S corporation is considered called pass-through entity for federal income tax purpose. The S corporation is required to file S corporation tax return, 1120S. However, if you file your tax return on time, even file extension, and then file within the extension time, you find yourself, you not even pay a penny to IRS for your S corporation. You need to file tax return though. If you file late, there's a penalty. And then you just pay to state of California about 1.5%. So now, here's an example. For an S corporation or a C corporation with the same 100K, again, it's like 21% plus 19% plus 30%. So for C corporation, it's about 30K. For S corporation, federal does nothing. State of California, 1.5%. It's 1,500. You can save 28,500. Just choosing S corporation, same 100,000. The good news is, for the tax year 2021, you still can have a late S corporation election before 2021. For the 2021. Yes, for the 2021. A lot of people say, I passed due day, I cannot go back for the 2021. No, not in the case of S corporation lay election. But the lay election is to have a special way to do so though. Well, if some of you using the sole proprietorship, which means you have not been set up a corporation, not set up partnership, so you are filing tax return in Schedule C. Let's say you make a net income of 100K. Now the taxpayer need to pay 15.3% self-employment tax on top of normal income tax, which in this case is 15,300. Here's the bad news. You cannot make any changes for the year of 2021. You cannot go back to say, oh, let me change it. You can only take tax planning to choose a right legal entity for the next fiscal year, calendar year, which is 2022. Now we're going to tips number 5. Selling your property in the right time, in the right way. The 2 words. Right time, in the right way. Taxes at 4 different kinds of property. The first one is tax on primary residence. The second one is tax on the second home or vacation home. The third one is tax on the rental property. The fourth one is tax on the investment property. When you go through each and every one. Well, tax on the primary resident, it's of us, if you are U.S. tax resident, each person have 250,000 tax-free capital gain for their primary resident if they own and live on that primary resident for more than 2 years. And with some exception, and they are less than 2 years, they still can apply. And today we are focused on the general rule. So in general, it's 500,000 for a couples. Does husband and wife have to be on the title in state of California? As long as the spouse, the name is not on the title and do not declare, it's only the other spouse personal property and the spouse doesn't have a name on there, it not belong to them. As long as you don't sign those and document it. In the normal situation, you have a legal marriage and live in state of California, like in this situation, community state, and I esteem it as both of you own, even your name is not a title. Now that I'm talking about for the state of California for the community property, not necessarily applying for other states. If you have an adult kid who live with you, and you may consider adding their name in the title to receive additional 250K tax-free capital gain. If those adult kids also own it and use it as a primary resident for more than 2 years, their name must be in the title. They must use in this one as primary resident, their driver's license, their voting, their bank account, their cell phone bill, so on, had the evidence that their tax return had to use this address. Now, any gain over tax-free capital gain is taxed as regular capital gain in Schedule D. It's in Schedule D, not a rental property. Any taxable gain for selling the primary residence can be offset by capital loss. as long as not what sells. For example, some people who may have some capital loss carryover from some previous year. And now, after you take those 250,000 per person, and then you can offset it. Okay, so now there's a one thing the primary resident cannot do 1031 exchanges. There's no exception for this rule. I say you cannot double dip it. I already give you this exclusion, 250,000, you cannot do 1031 exchanges. Number two, tax on the second home and vacation home. There is no 250,000 tax-free per person for second home and vacation home. Even though the second home and vacation home, their mortgage interest and property tax could be deducted in Schedule A and subject to limitation. But there are no 250,000 tax-free. But somebody say, what if I live in my original primary home for 2 years, 2.5 years, and then I switch to my second home as my primary resident? So can both of them qualify? Yes, but you have to be evident. You have to file tax return. You have to different, and you also have to be show a driver license. You also have to show all the things that the primary resident need to be shown. Now, the second home, the capital gain is reported in Schedule D. It's also okay to offset with the capital loss carryover. Normally, the second home and vacation home cannot do 1031 exchanges, with one exception. With one exception. So here's the exception. The second home and vacation home, okay to do 1031 exchanges if you fulfill those requirements. In 2008, I give you a guideline to how that can qualify. In a very simple word, if you see those bullet point in the second one, that is very strict. You can really only for fair rental, like there's only like 14 days there. But if you don't meet those requirements, you're not qualified. So when you apply it, intend it to 1031 exchanges, make sure you qualify this law. So that way your second home will qualify to do 1031 exchanges. Okay. The tax on the rental property. The tax on the rental property is the most common. And the first, rental property does not have 250,000 tax-free gain. Also, it's not reported in Schedule D. It reported in Schedule 4797. Also, one very important thing, they need to recapture accumulate depreciation. What that really mean? All this year, let's say if the rental property per year is a 10,000 depreciation, if you have been renting out for 10 years, which means 100,000 accumulate depreciation. In the year when you show it, this 100,000 accumulated depreciation will recap it as an ordinary income. He said, wait, What does it really mean? Depreciation is a tax deferred. It's not tax free. You pay them all in the year of sell the house. And people say, what if I have not been taking depreciation in my rental property? So do I have to recap my depreciation? What do you think? I never take it. For all this year, I'm supposed to take it 10,000 per year, which I did not take it for 100,000. The IRS said it's allowed and allowable. What does it really mean? We give it to you, I said, we give it to you 10,000 per year, allow you to take it. You don't take it, too bad. It's your fault. You still have to recap 100,000. It doesn't sound very reasonable, but this is law. So in a normal situation, you can only amend 3 years tax return. So now in this situation, how about the 7 years before those 3 years? Under a normal amendment, you won't be able to do it. But luckily, there's one legal way to recap all those forgotten depreciation for all 10 years. It's a very special process you have to do it, not through the normal amendment, like 3 years. It is okay to do 1031 exchanges for rental property. Again, 1031 exchanges is not tax-free, it's tax deferred. They carry over the cost basis. So it's not today's subject. We talk about 1031 exchanges. So now let's talk about the next items. Tax on investment property. The property was purchased for investment purpose. What does it really mean? You buy a house, you do not use it for yourself to live, nor you rent it out to collect a rent. Not the second home, not a vacation home. In this situation, you're looking for appreciation. You're looking for flip houses. And some of them, if you flip it and looking for the price increase. Some of the house you may doing fix it up and some improvement, and some of them you have not been. But it doesn't matter. At this situation, you're looking for appreciation. That's the whole purpose. That's why I call investment property. So what is the big deal of this whole thing? Well, investment property is okay to 1031 exchanges. There's no depreciation allowed during the holding period. So therefore, there's no depreciation recapture when you show, because you doesn't generate any ordinary income. So remember, when you have an investment property, you should not report in your Schedule E. It doesn't show on your tax return until it's sold. It's just like very similar, like when you buy a stock, you have not sold it, it doesn't show it up in your tax return, right? So it's okay to do 1031 exchanges. In sum it up, normally, what property can do 1031 exchanges? Normally, rental property and investment property, and with the exception of second home and rental property, second home and vacation home. The exception, not the general. In general, primary resident, you can not do 1031 exchanges, and the second home and vacation home only in a normal situation you cannot do 1031 exchanges, only with the exception. What if I use my primary home, portion of it as a primary home and portion of it as a rented out? Well, you cut your houses by portion. Let's say 50-50. 50% it, you can apply the 250,000 rule for exclusion, and the other one you can do 1031 exchange for the other half of it, or you pay capital gain onto it. But you need to duly capture. But here's a good thing I want to tell you. As I go into tips number 6. Home office. When you're doing business and you don't have other office, or you have it, but you still need your home portion of your home for home office. A lot of people scared. Should I use in home office? I say, why not? If you use it exclusively for your home office, you should. You don't need to worry. The tax law is permit you. Would that increase the audit chances? Not necessary. If you're doing things reasonable and with the strong support, you should just go for it. Now, here is a okay. Now here is what I want you to do. I want you to ask to know this. In the past, if you're using a 10% or more of the home as of home office, and you have to do the recapture. And when you sell these houses and you take the 250,000, you have to minus those recapture. That's why I discourage a lot of people take a home office. But here's the good news. Very seldom I ask change the law to let you get both benefit. You can get the home office deduction, and when you sell the house, you don't have to recap it. Yes, the new law said you don't have to recap the depreciation, and you don't proportionally do the houses, and you can take 100% of it to qualify the 250,000. Tips number 7. To take advantage of Section 179 vehicle and equipment tax incentives. So what is the 2021 deduction limitation? The maximum deduction for 2021 is $1 million and 50,000. Well, this deduction is used to only for a new equipment. The new law said it's okay to apply for new equipment and used equipment. For example, you can buy a new car, you can buy a used car, you can buy a new machine or the used machine, you can apply for it. This is a new law. The spending cap is huge for Section 179. It's 2.6 million. When it's gonna like phase out about it, it's about 3.6 million plus. So in a most situation, a lot of people have not been fully used this Section 179. Now here's the thing. What is the extra bonus depreciation amount? Normal depreciation write-off take over the lifetime of the equipment, normally 5 years. The current law allow you to take 100% bonus depreciation for the year you purchase. The business equipment deduction as follows. For example, if you purchase 1.5 million, the very first year you can write off is 1,050,000. Don't get confused. 1.5 million purchase, 1,050,000. The bonus depreciation for the first year is another 100,000. The normal first year depreciation, because you already take the bonus depreciation, there's none. So therefore, the very first year depreciation is 1 million plus 50,000, 1,050,000 plus 100,000 plus 0 equal to 1,150,000. Hey, just for the further alone, it's great tax saving. And don't forget, you still have a stay. Use it. Okay, I'm going to answer those questions a little bit later. Okay, very good questions. Now, Section 179 is an exception opportunity. So I want you to know you should use it. Now it's a very good opportunity. A lot of company is on sale for their equipment. Hey, what if I buy something, I finance for it? Can I qualify? Yes. You only maybe down payment, you do not pay in full yet. You can finance it, but you can write off 100% up to this maximum. That's a pretty cool deal. Now, let me ask you this. So at the end of the day, what kind of expensive equipment can qualify Section 179? The foreign all qualify. But you have to make sure those purchases must be done within 2021. It could be new and it could be used. But the transaction must be done on or before December 31st, 2021. You have 40 days to go. Now, I stand out that business vehicle over 6,000 pounds, you can take the full depreciation for the full purchase amount for the business portion. If the business use more than 50%. Now, those are qualified. Now, there's one thing you have to remember. For example, you bought a car. If you intend to use Section 179, the car must be used for the business more than 50%. If you don't, you're not qualified. So here is the normal cap for depreciation. If they are not over 6,000 pounds, those are the limit for the vehicle less than 6,000 pounds. Doesn't fulfill the 179 and those are regular. Hey, what if they're over? Well, they're over, they still have the law. Yes, that's true. Now, how about some of you lease a vehicle? Can you deduct all of them? There is a called lease inclusion table from IRS, and you have to include those amount as your income. A lot of people forget to do so. I don't have time to go detail, but this is one thing you have to remember. Now, there are some vehicles that over 6,000 pounds and they're okay to take 100%. That's why you saw a lot of business owners to do so. But you have to be evident is a business use purpose. Now, I would like to say thank you for you to listen to my presentation. I am going to open for questions to Q&A. So now I'm going to stop my sharing screen so that way you can listen to me. Okay, so you can unmute yourself. You can raise.
Yeah. Let me just read off some of the questions we collect from the chat box, which I think would be better. Yeah, because we already have a couple of questions. So out of you have 3 questions, you might consider to answer one by one. So basically for the tax record, can it be kept in electronic format instead of the original format? Like you mentioned, that it might be good to keep all the records indefinitely.
I would say this way. I would strongly recommend you to keep the original record at least about 3 to 6 years, and then convert those in the electronic record. Sometimes sometimes IRS accept the electronic format and some don't. But as you can see, for 3 to 6 years, you need to keep it. I would suggest you to keep the original record in about 3 to 6 years, and then you can, as time pass by, you can convert those, become electronic. That's what CPA normally more conserved. Yeah.
Yes, got it. So when to select C corporation over S corporation? So
anytime. I really mean anytime. And anytime you can make a C corporation become an S corporation, but you have to have a reason, and you have to tell IRS why you're late and why IRS should approve you. But some CPA have experience; they know how to make those fulfillments. So it's anytime you can do it.
Yes.
May I ask one more question derived from this one? What I try to ask is not a time, it's the region, and what the situation you will select the C Corp over S Corp.
Well, first of all, you have to qualify to become an S corporation. In order for you to qualify as corporation, there's a few things. Number one, certain company, for example, life insurance company, they don't allow you to do S corporation. So the IRS lists certain company, it doesn't have a lot. You cannot do S corporation. So you make sure you're not on the list, right? In this situation, on the list is not cool. Then that's number one. And number two, you don't have any foreign shareholder. You don't have, it's all 100% US tax resident. Number three, you don't have more than 75 number of shareholders. So in detail, in most of the people could do it, and people who have experience, they know how to do qualify. It's in every situation are different. It's very difficult, I can say, how. It's not like that.
Well, Lee, I would encourage you to contact Philip directly. You know, we're going to share his contact. You know, like you might have an individual circumstances that you might want to share with the CPA. Okay.
Thank you.
Yeah.
Each and every person have up to 45 minutes for free of charge. You can go online. You can book an appointment with me.
Yeah, that's very good to know.
Okay.
And in terms of like 10% threshold, is it going to, just to confirm that it will be removed for next year, but still in 2021 this year?
You know what? For this question, you're talking about 2022, right?
Yeah, they're asking, LW asking whether the 10% threshold will be removed for next year, but it's still on this year.
For 2021, yes. For 2022, I actually do not know. I need to check. Okay, so we're talking about right now. We are in 2021. For the tax year of 2021, yes. For the tax year of 2022, I don't know. But for the time in the year of 2022 doing tax return for 2021, yes.
Okay, got it. Yeah, so we got to wait and see. Can landlord deduct new vehicle purchase used for, say, exclusively more than 50% for running rental errands, such as repair and purchases? So we're talking about individual instead of like a S corporation, say.
It doesn't have to be have a S corporation. It could be a Schedule E. It could
As
be a
long
Schedule,
as
but you have to
I
be.
see.
You could treat all your rental property as one. Like for example, let's say you have 5 to 10 of the rental in your Schedule E. You can treat all of them as one. But there's a box you need to check it, and inside the tax return, so that you can evidence yourself. And then more in this is like do a legal support and planning, so that way when you face an audit, you say why I have more than 50%. Yes.
Yeah, so like Kelly, you're encouraged to reach out to Philip to get all the details before you try to set up, like a claim on this.
But in the most situation, let me answer Carrie's question. That's probably very common questions.
Yes.
And if you set it up an S corporation or LLC, it probably might make it more easier to evidence yourself. And then you also title of the car is under the S corporation or LLC. Okay. Very good.
I see. Yeah. So like, because there would be, maybe we will jump to Anna's question, say the tax benefit for an LLC entity. So you just mentioned it might be better to set up an LLC. Then it would be easier to claim, say, new vehicle as part of the expense, right? And what other tax benefits would there be?
Well, the LLC, if you don't do any smart election, the LLC is not really tax benefit, because the tax is a partnership, which is subject to self-employment tax. And state of California LLC tax, besides have a minimum of 800, there is another tax subject at gross. But the good news is you can choose an S corporation LLC to tax as an S corporation. So that way, for the same LLC, the same tax growth, you could legally achieve less tax for both federal and state of California. So, okay. So in terms of in the most situation, the LLC also have legal liability for protection. So in the most situation, it's a very good advice to do so for the LLC. Yes.
Yeah, got it. So this is a follow-up question from Anna. She said, well, the LLC is formed to hold rental properties. So the rental properties does have like capital loss when selling the rental property. Can this capital loss from LLC used to offset the capital gain from primary residence sale? If say they have a gain more than 500K for 2 people. Can the sale of the rental property loss be able to offset it?
Now, here's the good news. Anything in LLC, let's say you choose it, is either partnership or S corporation. They are called flow-through entity. So any those losses will eventually through K1 go to your 1040. Yes, the answer is yes.
I see. Okay, that's good to know. Now going back to LW question, saying regarding the new changes on Roth IRA backdoor, do you have any information to share?
Probably today, we have not been. I was thinking about when I prepared, and I was not. That will be open, and I also not mentioned about it. So maybe leave this question for next time. I need to have a little bit more time to give you background information. So maybe we focus on what we're talking about, and other thing is better. Yes.
I see. So I think, LW, you can reach out to Philip regarding specific question, and also, about the remaining 40 days for 2021. So you have to explain to Philip about your scenario, because
Yeah.
sometimes, you know, you have different holdings, which is different from others.
That's correct.
Yeah. So like, it's a follow-up question from Kelly, is that a couple have 500K exclusion for primary. If they have one adult child living at home for more than 2 years, can they deduct 750K exclusion? And I guess, you know, they have put the kid on the title. What is the tax impact by adding an adult child on title? Can it lower the percentage of ownership work, or it has to be equal, like 1/3, 1/3, 1/3? Does it matter?
No, the law said you own it, you can have a say to do any percentage. And yes, it's legal to add anybody, but you just need to file gift tax. Gift tax file, but no tax. Because when two of you, husband and wife, to add a kid's name onto it, you literally husband and wife just give. So therefore, there's a gift tax need to be due, but there's no tax due. And then when you sell this, as long as they own and live there as a primary resident for more than 2 years, each and every one of them qualify up to 250,000. Yes, there's 750,000. They also, the kid is taxed on their own tax bracket. Here's a very good questions. When somebody does not have a very high normal other ordinary income, their capital gain is very reasonable. That means lower than parents.
Mm-hmm.
Okay. And
Yeah,
that
I
is
got
a
it.
very good, I think we are in the recording and we are going to put it in the YouTube. And this, for this answer, I think this is all I can say. Okay.
Mm-hmm. Got it.
Mm.
So, like we have many clients, they have a number of rental properties. And if they move into one property after they rented it out for 10 years and lived there for 2 years, and when they sell, they can still claim the 500K tax deduction. And do they have to recap some of the gains that they make from rental, or they get everything else would be kind of like treated as a primary, if in case, you know, like they do not exceed 500, or if they exceed? So what would be the scenario like?
Let me ask you your question, your answer. What do you think?
I wish I'm a CPA.
Well, here's the good news. There's a bad news and good news for this situation.
Mm-hmm.
We all know how to make sandwich, right? We all know
Mm-hmm.
how to make sandwich. If that property you showed it to start with rental, start with primary resident, and then rental, and then primary resident. So it's a
Sandwich.
primary resident first,
Mm-hmm.
rent in the middle, and then you go and take it back as a primary resident. You don't have to prorate it, and only in this situation.
I see. But
So
how
you
did, what if, yeah, go ahead.
You start with as a primary resident, you end with as a primary resident. You ever done it in your tax return, you ever done it in all support documents to say this is your primary resident. If you do so, even though you rent it in the middle, have a long period of time, the new law said you don't have to prorate it, and only in this situation. Other than this situation, other than this good sandwich, nothing get excluded, which means have to prorate it.
Prorated. Got it.
Mm-hmm.
That's something that so glad to learn about it today.
Mm-hmm. Make sure the right sandwich though.
Yes,
And
yeah,
to
the
put
proper
two bread,
sandwich.
put two bread, the meat in between. Rental is the meat. Two bread.
Yeah.
Okay, it's that.
Yeah, the
Primary
good
resident.
sandwich. Got it.
Okay, but if you're any other way, it doesn't. You cannot put two meat and put the bread in between, right? It doesn't look right. or you just have one bread and one meat. It doesn't look like normal sandwich. Okay,
Mhm.
it used to have to be paraded, but the new law allow you to do so. But you had to be very careful to evidence yourself. You're not planning to do so. The tax fraud, what is tax fraud? You planned it to do so. You cannot be making a tax fraud. Next question.
Okay. Well, I think Kelly's question already been answered about like deducting new vehicle, but I do have some question about estate tax. So we know that estate tax right now currently they have more than 11 million each person for say parents, each of the parent, you know, for gifting, say if they're gifting to the next generation, they now like have more. But by end of 2025, December, is going to be possibly sunsetting to about like 6 million per person. So is there any suggestion on how family can start taking advantage of this estate tax exemption, the bigger amount now, you know, until like say we reach to a lower amount by 2025?
Well, the God law said you don't know when we're going to be the last day of us. So therefore,
yes,
it's up to the God to say so. But there's one thing. Each and every year there is an exclusion amount. It's outside of the it doesn't. So many of you really exclude exclusion. Many of you exclude this exclusion, just raise it. So you should consider if you have the estate tax potential problem, you should actively think outreach to your CPA and your lawyer together to be maximum use each and every year's exclusion. So that way, the annual exclusion as each and every year husband and wife to give to other person per person. So that way, you can give it to as a money. You can get it as like you add their name in the rental property to count it in that amount and give it to them so that the rent percentage changes accordingly. So other than that, because the day you cannot determine when you cannot, there's nothing you can really do. But always, do you have planning to do it? Yes. But you need to sit down with your CPA and the lawyer together to try to come with a good triangle. Yourself, your CPA, and your lawyer work together. So that is how the estate planning is supposed to be done.
To build on top of that, when you see we can give the, for example, my children's gift every year, my husband and I, and to reduce the escrow, as the 遗产, but
yes.
But we have to consider if give money, okay, if give the share of the real estate property, we have to consider whether we can have a step up or not, right?
Well, during your lifetime gift, there's always a carryover basis. Only is that when somebody pass away, and that is there, so that will step up. Well, right now in this situation, you won't get a combined. You won't get a combined. Knowing it, if you're going to be over the limit. Knowing you're going to be over the limit, those legalis is going to be subject to estate tax. The estate tax most likely is more than capital gain.
Thank
so
you.
You're better off to make a switch, make the annual transfer. Now, annual transfer, very common thing, could be money, could be purchase some life insurance and paid by the parents or grandparents, or the percentage of or the dollar amount of the rental property, or your primary resident. You can give it to them primary resident.
Mhm.
Thank you.
Yeah. So we
Okay.
have to be creative.
Well,
So
everything must be legal and for the law.
yes.
If you do it over the law, it's fraud. If you doing the law, you don't do it, it's called dumb.
I got it. That's why you need a good CPA and a good lawyer to find out ways to do it properly.
Yeah, everything must be legal, but within the legal format, if you have to know what is right, what's not right. It sounds very complicated. Tax planning, all the 3 steps is very similar when we drive on the freeway. And when you go in the freeway, and if you can go in freeway and go like from point A to point B, you can go freeway, you can local, you can go to slow lane, mid lane, and fast lane. But when you do those, get into it. Well, if there's a traffic, you don't want to get into it. But if it's the straight out, why should I take local? I should take a freeway. So it's like based on each and every person's situation. You also need to remember the 3 steps. When I say 3 steps, it's really a cycle. And that's what, if you say, it looks like today I give you a title called 7 tips. But in fact, I want you to take away is that before that, it's a 3 cycle. And that's even more important than the 7 steps. You get yourself to create a good habit of take care of your tax matter in the right 3 steps simultaneously. It's the 3 steps we try. 3 steps with triangle, you will be good. 3 steps with yourself, your tax and financial advisor, and your lawyer. That's a triangle. A combination. For example, the real estate professional, they are part of the team. The CPA part of the team. Your financial advisor part of the team. So that belong to one group. So if that 3 triangle plus 3 steps. Other than that, all other things are temporary. I give it to you. Those tips are temporary, but the habit, the steps, the procedure, the critical thinking, and make the sound decision in the right timing. That's what matters. Okay.
Got it. Yeah, so let's address this last question and then we'll wrap it up. I know you're busy. And so this question is from Kellen. Say for IRA contribution, IRA, if the couple is over 55 years old and no extra income except Social Security, can they still contribute to IRA? And what would be the maximum amount?
Well, 2 days ago, I just turned 55. This person probably just turned 55, isn't it?
Could be,
well,
could be.
Well, good for you. I'm still working. I need to apply for retirement for my wife. Well, unfortunately, if you don't have an earned income, you cannot.
No earned income, so cannot contribute to IRA. And also 50 years.
Unless there's a spouse is working, and then the other spouse doesn't work. There's a spouse IRA. But if both spouse is not working, it doesn't have an earned income, they could not.
So unless it's earned income, they will not be able to contribute to IRA. Got it. Yeah. So like I do have one last question. I hope that would be the last one because we know that Philip has other commitment. So for rental properties, would it be better to set up LLC for protection which is like $800 per year for, you know, for the minimum tax. And if each property has an LLC, or just buy a blanket umbrella policy. What is your thought?
Okay. Let me say this way. When you go to see a doctor, you just do like your checkup. If you have no problem, your doctor will not give you any prescription. But even after the doctor gives prescription, you as a patient, it's your right to make a decision to go to buy or doesn't buy or not. And then after buy it, whether or not you eat it or not. But in this situation, each and every person are different. Let's say this way. You most likely, when you raise this question, you most likely have not had an LLC in your life yet. There's no right or wrong answer. There's no right or wrong answer. It's a make sense answer or suitable and affordable. It's a suitable, it's make sense, suitable, and affordable to you. So for you, it's more protection, it's more business sense, and especially make yourself, a lot of times, let's say for the rental, those policy, it doesn't cover what the LLC cover you. In the reality, for LLC to set it up, the pay state of California, $800 is tax deductible. If you take the consideration, it's really out of your pocket about $500. And what I can say, I said this way, you should consult your CPA and your lawyer. Go through the triangle and you make your sound decision. Let me say it this way. I did not answer your question straight, but this is the best I can answer. Go through 3 steps and 3 triangle. And if you walk away with today, it's the 3-step, 3 triangle with the 7 step. That's what I was want to give it to you.
Well, we encourage Little Red to contact Philip privately. You know, like you have to explain about the scenario, you know, whether you have commercial properties, single home condos and all this. Maybe you can find out more, and also, you know, the type of asset and all this. Okay. So,
hey,
last
Monica,
question.
Monica.
Yes.
Monica, can I ask one last question? This is Helen.
Helen,
yes.
Philip.
Yeah, go for it,
Yeah.
Helen. Please do.
Yes, thank you. When you make a gift tax, you know, the 100 to the estate tax, the 110 million for couple. If you make a gift tax, let's say you make $2 million transfer to your kid, the property, is that deferred until you die, or how is that tax being figured? You know, how is that
Okay.
that $2 million that you did not pay tax on, estate tax, or, you know, calculate? How is that calculated?
Well, there's 3 different things. You're talking about only 2 different things. Now, right now, for example, during your lifetime, when you give to somebody, there are 2 ways. And then when we pass away, that's another way. So now let's talk about when during our lifetime right now, if it's under the annual exclusion, you do not use it up your lifetime credit. And that's what I encourage you to use that. But if you're over,
is that the 15,000 or whatever?
Yes, that's correct.
Per person. Okay.
Per person
What
per year.
happened to the $2 million? The $2 million, that's a big sum.
What do you mean?
Let's
2
say
million?
you're 90-year-old. No, let's say you're 90-year-old, you gave $2 million away. And then a couple of years later, you pass away.
Are you talking about your rental property? Are you talking about the rental property? Are you talking about worth of $2 million rental property? Maybe bought it.
No, owner occupied.
Well, depends. In a normal situation, I don't think it's a good idea. I don't think it's a good idea to during your lifetime to do so, right? Because why you want to do that? Unless you change.
Prop 19.
Unless
Prop 19.
Yeah, you cannot. Now here's one thing I want to tell you. When it's too good to be true, it's most likely not true. So Uncle Sam, there's like grandpa is called Uncle Sam IRS. There's father is called in state California franchise tax board, and then you get a son or county and city. So different person will go to you in a different purpose, and you cannot go to one strategy to get all good. You can only get one or two, probably most in this time, in a combination. But each and every person are different. Go through the steps. There's no way you can shortcut. There is no way you can shortcut in taking care of your tax matter in the right way, in the right timing. Listen to me very carefully. In the right way and the right timing. Take time to do it right. Just one step back to do that step process. Don't jump to the conclusion. Don't jump to the solution. Going backward to see it. Involve those other two group of people, and you will get the best of it. Okay.
Yeah. So Helen, I would recommend maybe set up a private time to talk a bit more with Philip on the scenario, because like say he can give you an idea whether that 2 million will be deducted from the lifetime. Say if now is 11 million, deduct from that. So, but it might need more tax planning on that. But I'll give you his contact later. And so one really last one. So just want to address this one. This will be a quick one. So for the earned income made in US will be qualified for contribution to IRA. But how about overseas income? Is it only limited to USA income?
The overseas income, you have an option. To make it subject to self-employment tax, even though you take in a foreign exclusion. The foreign exclusion only excludes the regular income tax. And in tax software, there's an option to subject to self-employment tax to pay for it. If you do, and you qualify. If you don't, you're not qualified. So you cannot get double dip basically. The foreign exclusion, you exclude ordinary income, and then you also, if you get it like similar like W-2 income, and you also exclude it as a self-employed tax, and that you won't be. Now that's up to conclusion. If you have your own LLC or S corporation, you can pay yourself. You can pay yourself payroll.
Yes.
Hey. Let me ask this. Look at the background. There's a Golden Gate Bridge. There's a sun right there. There's always a hope. There's always a brighter future if you plan it right. And let me leave with this one to you. I'm here to help if you need something, because each and every person tax matter is very private, and we are in recording since. And I cannot ask you too detailed situation. Therefore, I won't be able to give you a right answer. So I welcome you. So I have all my information available. I really enjoyed today's presentation. Do you guys like it?
Yes, very good. Yeah, very informative. We learn a number of things, that is really going to help us with the tax planning. Really appreciate your time. Yeah,
no
very professional. And for everyone, we're going to send you the PDF form of all the today's slides and also the recording once we have finished loading it up on YouTube. Again, thank you so much, Philip. Please have
You're
a very
welcome.
good, afternoon and also the rest of the weekend. And thank you
Yeah.
very much for everybody attending.
Oh, let me
Goodbye.
ask you. No,
Yeah.
let me tell you one thing before I go further. So there, I have Monday to Thursday, 10 p.m. to 11 p.m. Okay, so every week I have classes. So welcome everybody. If you want to learn more from me, right here. I share screen and say.
Yeah, when
literally
I
myself.
send out the information, they would have the information. If they're interested to log in, they can log in.
Cool. Thank you very much. Bye.
Yeah.